Welcome to the deep dive. Today, we've got a specific mission, just like you asked for.
That's right.
We're cutting right through the usual earnings call chatter. We're focusing only on the CFO's prepared remarks about the financials and operations from Q3.
Yep. No CEO comments, no Q&A this time around. Purely the numbers and the strategy presented by the finance chief.
Our goal here is really to pull out those key metrics, understand the strategy, especially around balancing today's profits with those, well, massive future bets on AI.
Exactly. It's all about that context.
And right off the bat, the big headline. The CFO basically said this was a huge record-setting quarter, not just in one area, but across the board.
Yeah. Multiple records, total revenue, energy gross profit, energy margins, and free cash flow, too. All new highs.
That really sets the scene, doesn't it? Record free cash flow is always a big one.
Okay, so let's unpack the record-setting part operationally, starting with, just getting products out the door. Deliveries and deployments hit new records.
Right, so how did they pull that off? What was behind that acceleration?
Well, the key thing was it wasn't just one place. The strength was really global, which, helps spread the risk.
Right.
They specifically called out some pretty impressive sequential growth numbers, too. Greater China, up 33%.
Wow, 33%.
Yeah. Then APAC, that's Asia Pacific, up 29%. North America saw 28% growth.
Still very strong.
And AMIAs, Africa, Middle East, India, that was close behind at 25%. Seeing that kind of simultaneous growth everywhere suggests their whole setup, their supply chain is really clicking.
That ability to deliver everywhere at once, yeah, that's often kind of overlooked. And they linked this delivery success back to the Model Y, right? Their main volume vehicle.
Exactly. They've been pretty strategic about it this year. You remember they launched the new Model Y way back in Q1.
Mm-hmm.
Then they followed up with the long wheelbase and the performance versions. And just recently, they rolled out the standard Y in North America and AMIA.
So a deliberate step-by-step release.
Right. It seems like that measured rollout for their biggest seller was the key lever they used to keep that delivery momentum going strong all year. Okay, so let's connect that operational success, all those deliveries, to their big tech play. Autonomous driving, the cars are selling, but how's the autonomy part going?
Yep.
And critically, how does that feed into vehicle margins?
Yeah, the real-world deployment story is interesting here. The CFO mentioned the robo-taxi is now running in Austin and most cities in the Bay Area.
Okay.
And what jumped out at me was that they've already expanded the service area in Austin 3 times since they first launched it there. That seems pretty quick.
It is, and, it's something that maybe doesn't get enough attention compared to competitors. Their fleet just blends in.
How so?
Well, the cars are designed for autonomy from the start.
Yeah.
They don't need all those extra bulky sensor pods you see on other test vehicles, the ones that make them really stand out. Their current cars are basically ready for it.
That makes the software side, the FSD supervised adoption, even more important for making money down the line. But the CFO gave a bit of a reality check on the numbers there.
He did. They expect demand to go up as more people try it out. But the actual number of people who've paid for FSD is still pretty small, only about 12% of the current fleet.
12%, that's lower than you might think, given the hype.
It really is. That 12% shows you how hard it is to turn that operational scale, selling all those cars, into immediate software revenue. Suggests people are hesitating maybe the price, maybe they're not convinced by the features yet, or it could be regulatory hurdles.
And they know they need to scale it globally, right?
Absolutely. They confirmed they're working hard with regulators, specifically mentioning China and AMIA, trying to get approvals to deploy FSD there. They know getting this feature out worldwide is key to hitting, critical mass.
Okay, let's shift to the car financials then. Automotive revenue up 29% sequentially. That lines up perfectly with the delivery growth, which makes sense. But the margins, that's always the big question mark. How did they do there?
So automotive margins, and this is excluding the regulatory credits,
Yeah.
they did improve slightly. Went up from 15% in Q2 to 15.4% in Q3.
Okay. A small step up. What drove that?
2 main things, according to the CFO. First, lower material costs. They're getting better prices on parts and components.
Yeah.
Second, better fixed cost absorption because they made so many more cars.
Can you just quickly break down fixed cost absorption for us? What does that actually mean?
Sure. So think about the huge costs of running a factory that don't change much, whether you build 1 car or 10,000 cars like the building itself, the big machinery, management, salaries. Those are fixed costs.
Right.
When you produce a lot more vehicles like they did this quarter, those massive fixed costs get spread out over many, many more units. so the cost baked into each individual car goes down.
Ah, I see. So higher volume directly helps the per-car profitability.
Precisely. It's a really powerful effect when volumes ramp up like this. And importantly, the regulatory credits they sell actually declined from Q2 to Q3. So this 15.4% margin, that slight improvement, was genuinely from operations, not just credit sales.
It's easy to just focus on the cars, but the energy side of the business also hit records this quarter, didn't it? Even though there seemed to be some big economic headwinds there.
Absolutely. The energy storage part especially just kept going. Records again for deployments, gross profit, and margins. Operationally, it's a really strong segment for them right now.
But that success story has a catch, right? They talked about major friction from global trade tariffs.
Yeah, this is where global politics hits the bottom line directly. The CFO was quite clear. The energy business gets hit harder by tariffs, proportionally speaking, as a percentage of their costs of goods sold.
Why is that?
Because currently, all the energy storage products they sell are procured from China. So those specific tariffs bite harder there.
Okay, so that's a real cost burden. How big are we talking? And what are they doing about it?
It's significant. Get this. The total tariff impact in Q3 across both cars and energy was over $400 million.
Wow, over $400 million just from tariffs in one quarter?
Yep. And they said it was roughly split down the middle between vehicles and energy. Think about that number for a second. $400 million. That's like, what, 2.5 percentage points of potential gross margin just wiped out by tariffs?
So the fact they still managed to nudge the auto margin up to 15.4% while swallowing that?
It means the underlying cost savings they found elsewhere, like that fixed cost absorption we talked about, must have been really quite substantial to offset such a big hit.
And to fight back on the energy tariffs specifically.
The big move there is ramping up their mega factory in Shanghai. The idea is that producing energy storage products there for sale outside the U.S. lets them sidestep those particular U.S.-China tariffs for a chunk of their demand.
Makes sense. Okay, let's quickly touch on rising costs. Operating expenses, OPEX, went up sequentially. This is even after they've been talking about restructuring. What drove OPEX higher?
It came down to three main things, all pretty strategic, actually. First, legal costs related to various ongoing proceedings and also getting ready for that big shareholder meeting. That falls under SG&A.
SG&A selling general and administrative costs, right? Basically running the business outside the factory floor.
Exactly. Marketing HQ staff, legal fees, all that. The second driver was actually the cost of the restructuring efforts themselves, like consolidating their AI chip design teams to try and be more efficient long-term.
Okay. And the third one connects back to that big AI bet again.
It sure does. And this was probably the most significant one for the future. It was higher R&D spending related to employees. Specifically, they granted new performance-based stock awards to key people working on their advanced AI projects.
So investing in talent for AI.
Right. And the CFO basically flagged this isn't a one-off. He stressed that this strategic spending on AI talent is likely to keep increasing because, well, it's fundamental to where they see the company going.
Right.
So if you tie all this together, the overall financial picture is, well, they're generating record amounts of cash, even while they're signaling preparations for a really massive wave of investment coming up.
Let's talk cash flow.
Free cash flow for Q3, a record, approximately $4 billion.
$4 billion. That's a serious amount of cash generated in just 3 months. Gives them a huge war chest.
Absolutely. Their total cash and investments pile at the end of the quarter topped $41 billion. $41 billion.
Wow.
We should probably note, though, that their other income line item did drop compared to Q2, mostly because the value change in their Bitcoin holdings was smaller this quarter. It was an $80 million gain in Q3 versus a $284 million gain back in Q2.
Okay, so less of a boost from crypto this time, but still $41 billion in cash. Which brings us neatly to the future strategy. Current year capital expenditure, CapEx, is expected around $9 billion. Fine. But then the CFO dropped a pretty big hint about what comes next.
He did, and this is really the cliffhanger, the thing that shapes the next, say, 5 years for them. He stated very clearly that those CapEx numbers, they're going to increase substantially starting in 2026.
Substantially, not just a little bit.
No, he emphasized substantially. And this huge spending increase is specifically to get ready for the next big growth phase.
Yeah.
He explicitly mentioned funding the AI initiatives and the Optimus robot project.
Okay, they have $41 billion sitting there. Why wait until 2026 for the substantial increase? Why not start pouring that CapEx in now or next year? What does delaying that big spend signal to you about their AI timeline or production plans?
Yeah, that's a great question. It probably signals a couple of things. One, just the sheer complexity of the groundwork they need to lay first.
Yeah.
They're not just building assembly lines yet. They're building the core tech, the chips, the software, the AI models. That takes time.
Okay.
Two, it could be about managing expectations. They're saying, look, we're laying the foundation now, spending on R&D and talent,
Huh.
but the really massive physical build-out, the infrastructure needed to scale all this AI stuff and Optimus, that's still a couple of years away from kicking off in earnest.
So patience is required.
Very much so.
Mm.
The CFO finished his remarks with a pretty sober note, saying something like, bringing AI into the real world is hard. But the message was clear. They believe they're putting down the necessary foundation now for benefits that will play out over many years.
All right, let's quickly recap the key numbers from the CFO's review then. Record $4 billion free cash flow in Q3. Auto margins ticked up slightly to 15.4%, and that's despite taking that big $400 million tariff hit.
Right. Impressive resilience there.
And maybe most importantly for the long view, that clear signal of a really significant jump in CapEx coming in 2026, specifically earmarked for funding AI and Optimus.
So, given that the CFO himself said bringing AI into the real world is hard, and coupled with this plan for a truly massive capital injection in 2026, we have to leave you, the listener, with this thought to chew on.
Okay.
Beyond the obvious costs we know about developing AI chips, building Optimus prototypes, what specific major infrastructure bottlenecks or maybe production challenges are they anticipating down the road that would require such a staggering amount of capital starting in 2026? Are they planning for multiple brand new factories just to build Optimus? Or is it something maybe even bigger related to energy demands or massive computing power that we haven't fully grasped yet?
That really frames the core challenge, doesn't it? That long-term trade-off between hitting today's profit numbers versus making these enormous foundational investments in AI that might not pay off for years. Something to definitely reflect on.
Indeed.
Thank you for diving deep with us today.